our reading on Understanding the Income Statement with me, John Bone. Okay, straight into our first learning outcome that asks us to describe the components of the income statement. Now, first of all, let's just be aware of some alternative names they could throw at us in the exam that just mean income statement. It could be called the Statement of Operations, could be called the Statement of Earnings, or alternatively the Profit and Loss Statement, which tends to be more common in Europe. Okay, let's remind ourselves of really what's going on in an income statement. Remember, it's a dynamic statement spanning the date between two balance sheets, and it summarizes all the revenues, deducts all the expenses incurred in that period to give you an idea of net income. And of course, we may refer to net income as earnings instead. Remember what we said as well, IFRS may continue beyond net income by including comprehensive income items. Remember, comprehensive income can be shown as a separate statement or just tagged on to the end of your income statement. We need to be aware as well of two different format types for our income statement. A single step income statement. In this, essentially all of the revenues are shown separately and all of the expenses shown separately. So we group all of the revenues and all of the expenses. Compared to a multi-step income statement where we're likely to see gross profit separately, and we're going to have a look at a multi-step in just a second. Okay, so let's define some of the items in our income statement. Yet again, you can see we're talking about revenues, expenses and gains and losses that we've discussed in earlier readings. So remember, revenues are really the amounts reported from the sale of your goods and services in the course of your normal business. So in other words, they're sales, and they're your typical sales from your typical operating activities. And in fact, what we actually see on the income statement is actually net sales or net revenue. What we have is revenue less adjustments for estimated returns and discounts or allowances given to customers. So we actually see net revenue on the income statement. Expenses, well, we're going to see the amounts incurred to generate revenue, and we're going to include those in our cost of goods sold. And we're also going to see a lot of our day-to-day operating expenses, such as sales, general and admin expenses. Other things we're going to see in the income statement, financing costs such as interest and taxes. We may also see other items in there, such as unusual or infrequent items, and we'll discuss those a little bit later. Again, we're going to group our expenses together by their nature. So typically we're going to see all of the expenses related to producing our goods and services in cost of goods sold. We're going to see all of the day-to-day operating expenditure taken to run the business, things like rent of your property, rates, cost of the accounting function, cost of the audit, etc. in sales, general and admin. And then we're going to see all of our financing costs and other income separately. Remember, we might also see gains and losses in the income statement, and we're going to likely to see two types of these in the exam. Potentially gains and losses arising on the disposal of long-lived assets, so when you dispose of your plant, property and equipment, and they'll be equal to the proceeds received less the carrying value in the balance sheet at the time of disposal. And we may also see gains and losses due to the early retirement of debt, if we retire the debt at a value that's different from its carrying value at the moment of retirement. So let's turn our attention to look at our multi-step income statement here. So the first line we'll see in our income statement is the sales figure, otherwise known as revenue or turnover. We then subtract the cost of goods sold, and of course the costs of goods sold include all of the costs of making those sales. Okay, now we've got to be a little bit careful. Cost of goods sold includes all of the costs in getting your inventory into its finished state. Any additional costs will go through sales, general and admin. So we've got revenue, less the costs of manufacturing or buying in goods to be sold, and if we take off costs of goods sold from revenue, we get the subtotal gross profit. Okay, we then subtract our day-to-day operating expenditure, known as selling, general and administrative expenses, and that brings us down to operating profit. Now, operating profit is the profit generated from our key day-to-day standard operations. We may find that we've got some other income and revenue coming into the company that isn't related to our core business activities. It could be dividends that you're receiving from other companies, for example. It could be interest on loans that you've given to other companies. It could be maybe rental, because you've rented out maybe part of your property to another company. Anyway, the key point is if you've got any income and it is not directly related to your day-to-day business operations, then it needs to go in as a separate line. Then you can see we've got financing costs, and this of course relates to our capital structure, and typically therefore it's the interest on bonds, it's the interest on loans that we have in order to finance the business. You may then see unusual or infrequent items, and we're going to define these in a little while. Now, an unusual or infrequent item, if it relates to your day-to-day business operations, then it might go after the sales, general and admin expenses, i.e. before operating profit. If it doesn't relate to your day-to-day business operations, then you can see it's coming after operating profit. Okay, so that brings us down to income before tax. Let's continue the example on the next page. So we then have our provision for taxes. Notice this word provision being included here. What that means is it is an estimate, essentially. Okay, so whenever we see the provision, it's the idea that the accountants essentially are estimating a future expense. So it's provision for income taxes, and we're going to see it's made up of two things: taxes payable to the tax authorities plus the change in deferred tax assets or liabilities. In fact, an increase in a deferred tax liability is going to increase the tax expense. An increase in a deferred tax asset will reduce it, but we're going to see that in a later reading on deferred tax. That gives us our income from continuing operations. Notice the provision for income taxes is often referred to as the line, and we talk about items above the line and items below the line. Items above the line are all going to be reported gross of tax, and the tax on them is in the provision for income tax line. Items below the line are reported net of tax, i.e. their tax effect is netted off on a line-by-line basis, rather than their tax effect being in the provision for income taxes. Notice we've got two items that we're likely to see: income from discontinued operations, okay, and of course you'd be adding if it's income. If it's a loss from a discontinued operation, you'd be subtracting. And we've also got extraordinary items. Again, just be a little bit aware here. You see extraordinary items under US GAAP, but you will not see them under IFRS. They just don't exist. Again, we're going to define what these are in a little while. And that brings us down to net income, otherwise known as earnings, otherwise known as your bottom line. Our next learning outcome now comes up, and it asks us to describe the general principles of revenue recognition, and it also asks us to be able to calculate revenue. So we've got some calculate LOSs popping up now. Okay, so first of all, let's start off with international accounting standards and look at the requirements in order to record a sale. So the first one is the risk and reward of ownership should have transferred from the seller to the buyer. In which case, point 2, the seller should have no continuing control or management over the goods sold. In other words, that should all now vest with the buyer. We need to be able to have reliable revenue measurement. So in other words, we can put a reliable dollar value on the sale that we've made. It should lead to a probable flow of economic benefits, meaning, of course, the customer is likely to pay us, and as a result, there'll be a cash inflow in the future. And then finally, cost of the goods that we've sold or the service we've provided can be measured reliably. Now, of course, if we've got reliable revenue measurement and we know the cost can be measured reliably, we can start to record profit. Notice as well we've got recognition of revenue for services, which is slightly different. Notice it tells us here when the outcome can be measured reliably. In other words, you've got a reliable selling cost, normally a contracted selling cost, and you've got a reliable estimate of total cost for providing the services, then essentially you can book revenue according to the stage of completion. Now this is going to be very much like how we treat long-term contracts that we're going to look at a little later with some numbers. Now notice the outcome can be measured reliably if the amount of revenue can be measured, i.e. we can put a dollar value on the sales figure. It's going to lead to a probable flow of economic benefits, i.e. the customer is likely to pay us, and we can measure the stage of completion of providing the service. Notice as well we need to know the cost incurred to date and the remaining cost to complete the service or the provision of the service. Again, if we know a contracted selling price and we know the total cost, we have a good idea about profit. What this is therefore allowing us to do is it's allowing us to spread that profit over the life of providing the service rather than just recognizing it right at the end when the earnings activity is complete. Now notice when we look at the US Accounting Board, all they're really going to say is revenue, i.e. sales, should be recognized when it's realizable and earned. Earned means we've completed the earnings activity. Realizable means the customer is likely to pay us. Notice the SEC gives additional guidance for listed firms. Then we should know what these are for our exam. First of all, there's an evidence of an arrangement between the buyer and the seller. It could be a sales contract, it could be an invoice, it could be a shipping note indicating the goods have been shipped. Also, notice there should be completion of the earnings process, i.e. the firm has actually shipped the goods or completed the service. The price is determined, so we know what the price is, we can put a dollar value. And then the final one, of course, is the customer is likely to pay, so we've got assurance of payment. And of course, in that case, if we know the price and we know the total cost, we can start to record, of course, a profit. Remember, of course, if you're selling goods on credit, you need assurance of payment, because unless that customer pays you, you haven't got an asset. Because remember, assets are likely to lead to future economic inflows. Okay, so let's have a look. So most sales are recorded on the sales basis method, both under IFRS and US GAAP. In other words, you record the sale when the good or service is provided. In other words, when the earnings activity is complete. And for a large number of items, this is when the goods are shipped to the customer. Okay, but as well, notice not only does the good or the earnings activity need to be complete, we also need a high probability that the customer will pay us. Remember, if you've sold goods on credit, then you're going to record the sale and you're going to record accounts receivable, an asset indicating the customer owes you. And of course, you've only really got an asset if it leads to a future economic inflow of benefit, i.e. the customer is likely to pay. Now what we're going to then do is look at some exceptions to our rules of recording sales when the earnings activity is complete, or we've got reliable assurance that the customer will pay us. The first one we've got are long-term contracts, otherwise known as construction contracts. These are contracts where you're constructing an asset over a long period of time. And you can see we've got two rules here, the percentage of completion method and the completed contract method. Now, percentage of completion is the same under US GAAP and IFRS. Just be aware that completed contract is consistent with US GAAP, but is not used under IFRS, and we'll explain what IFRS uses in a second. So if you're undertaking a long-term contract, if you have a reliable estimate of revenue, i.e. a contracted selling price with your customer, a reliable estimate of total cost and time to complete, then percentage of completion will allow you to recognize sales over the life of the provision of the contract, rather than waiting until the earnings activity is complete. Now, completed contract method must be used when percentage of completion can't be used under US GAAP. So in other words, if you don't have a contracted selling price or you don't have a reliable estimate of total cost, then you can't use percentage of completion. Why? Let's think about it. If we have a contracted selling price and a reliable estimate of total cost, we know whether this contract is likely to be profitable. And if it is likely to be profitable, percentage of completion is allowing us to recognize those profits over the construction phase. Whereas completed contract is saying if you don't have the contracted selling price, you don't have a reliable estimate of total cost, you don't know whether overall it's going to be profitable. It's just too risky to start recognizing profits over the construction phase. So instead, completed contract says keep everything out of the income statement until the project is complete. Then on completion, when the product is actually sold, book all of the revenues and all of your costs, and as a result, all of the profits through the income statement. Now IFRS takes a very different approach, but it has the same bottom line effect on earnings. Under IFRS, you do report sales over the life of the contract. However, you don't report any profit. So all you're going to do is match sales revenue to the cost incurred on the construction project in that year. So sales and cost are identical, giving you zero profit. Which means, again, under IFRS, you wouldn't recognize any profit until the end of the contract when it's actually sold. However, you do have sales and you do have costs in the income statement. We'll have a little look at that in just a while. Now, installment sales, this is a bit of an oddity, very unusual in reality. This is when you've made an installment sale. What is an installment sale? When you are allowing your customer to pay you in installments. Now, normally with an installment sale, we just book all of the revenue, in other words, all of the sales, when the earnings activity is complete, providing we have reasonable assurance of payment. Now, these two methods that we're looking at here, the installment sales method and the cost recovery method, are used if you've sold goods and you're allowing the customer to pay you on installment, but you do not have a reliable, you're uncertain whether the customer will pay you. So let's look at the installment sales method first, used under US GAAP. It's used when the firm cannot estimate the likelihood of collection. So you're not sure whether the customer will meet the cash flows or pay you when the installments are due. So notice you don't know whether they're going to pay you, but you do know overall the costs of goods and services that you've provided. So what we're going to do is we're going to bring in revenues in proportion to the cash we've received to date, and we're going to bring in costs in proportion as well to the cash we've received to date. Now, cost recovery method is the most extreme. It's used when we've got two sources of uncertainty regarding our installment sales. Its source of uncertainty number one is whether the customer will pay you. Source of uncertainty number two is you don't know the total cost of providing the goods or services. Okay, so what we're going to do here is we're going to only recognize any profit once all the costs are recovered. So actually we bring in revenue, i.e. sales, exactly the same way as we do with the installment sales method, i.e. in proportion to the cash we've collected to date. However, what we do here is we match costs against revenues and don't book any profit until we've fully recovered all of our costs. Sounds a bit complicated, but we're going to see it with some numbers in just a second. Okay, so let's start off with an example that takes us through our percentage of completion method. So we've got Ledesma Properties here. They've got a contract to build a hotel for $2 million. So notice here we've got a contracted selling price. And we're going to receive that in equal installments over a 4-year period. We've got a reliable estimate of total cost of completing the contract of $1.6 million. Okay, significance here. We've got a contracted selling price and a reliable estimate of total cost. We're reasonably certain, therefore, that this project will generate a profit of $400,000. And because we're reasonably certain of that, we're going to the accounting standard will allow us to spread it over the life of the contract. Now we're told that Ledesma has incurred $400,000 in cost during the first year and $500,000 of cost in the second year. And the reliable estimate of total cost has not changed from year to year. And we need to calculate the revenue and profit recognised in each of the first 2 years. Okay, so this is how we're actually going to work out the cumulative revenue to recognise in our income statement. We take the total cost to date over the total project cost. So costs incurred over total project cost times the contracted selling price, and that gives us the cumulative revenue to date. Now, some of that revenue might well have been recognised in previous years, so we need to deduct revenue recognised in previous years' income statements, and that gives us this year's sales figure, this year's revenue figure. Then deduct the costs incurred in this year to get the profit that will show up in this year's income statement. Okay, let's have a go at it then. So remember, our reliable estimate of, or our contracted selling price here was $2 million. In year one, we've incurred $400,000 out of a total of $1.6 million. So notice, all we're going to do is we're going to bring in the revenue in proportion to the cost that we've incurred to date. So, essentially in year one, we're taking our $2 million, multiplying by 4 over 16 to get a revenue figure of $500,000. In order to get our profit, we just need to take the sales figure, $500,000, deduct the cost incurred in the year of $400,000, and we've got a profit of $100,000. Okay, in year two, we're going to take our $2 million contracted sales price, and we're going to multiply it by the cost incurred to date, $400,000 in year one, $500,000 in year two, so $900,000, and it's going to be $900,000 over the total cost of $1.6 million. Okay, let's see what the figure is that we get from that. I'm just going to have to quickly do it on my calculator. So 9/16, 900,000 over 1.6 million times our 2 million contracted selling price, and we get $1.125 million. Be careful. This is the cumulative revenue that we should have recognized to date. Some of that's been recognized in year one. In fact, 500,000 has been recognized in year one, so we now need to deduct the revenue recognized in prior years in this case 500,000, and we get this year's selling figure or sales figure of 625,000. Profit, take this year's sales figure of 625, deduct the cost incurred in this year of 500,000, and we've got our profit of 125,000. Okay, so expect maybe to see calculations based on that in the exam. Now, one question I often get in the classroom is, in year 2, surely I could have just done, take my 2 million contracted selling price and multiply by the cost incurred in year 2, 500,000 over 1.6 million, rather than the total cost incurred to date. And if I'd done 500,000 divided by 1.6 million, surely that would have taken me immediately to the revenue figure of 625. Well, that is true, but you've got to be aware that that method will only work if your reliable estimate of total cost is constant from year to year. Let's have a look at the completed contract method. So remember, revenues and expenses are not recognized in the income statement until the contract is completed and the goods are sold. So we're building a hotel for 40 million. We think that's its sales value, but we haven't got a contract to sell it. Cost to build the hotel is 32 million and costs incurred in year 1 is 6.4 million. So, sales figure, nothing. Expense figure, nothing. Income figure, nothing. Nothing goes through the income statement. Until, of course, we get to our final year when we'll book all of the revenue, 40 million, all of the expense, 32 million, and as a result, all of the profit, 8 million. Now remember, completed contract is not allowed under IFRS. Let's have a look at the approach under IFRS. So notice IFRS treatment. Remember, we do record sales, but we ensure the sale is matched to the cost until the project is complete. So whilst you've got a sales figure in there, you've also got a cost figure in there as well, and no profit. So let's have a look at the same example. Building a hotel that we think we're going to sell for 40 million euros. The cost to build it is 32 million euros. So we're expecting a profit of 8 million euros. Notice the cost incurred in year 1 is 6.4 million. So we've got an expense of 6.4 million. So all we'll do is we'll match our sales figure to that expense in the income statement, so we have 0 profit. So we'd have a sales figure of 6.4 million, an expense of 6.4 million, and as a result, 0 profit. Then, of course, in the final year, all of the profit will be booked. So once it's complete, you get the full 8 million. So note, therefore, that sales and costs are going to be very different compared to US GAAP, but ultimately, the profit, i.e. the bottom line impact on earnings, is exactly the same. Okay, let's have a think about how these methods, percentage of completion versus completed contract, essentially affects our income statement. Now, of course, net income over the construction phase is going to be higher under percentage of completion because you're recognizing profits during the construction phase. Now, of course, that's going to be the same in every year of the construction, but in the final year, of course, completed contract would have a higher sales figure, a higher expense figure, and a higher profit figure because under completed contract, it's all recorded in the final year. So under percentage completion, we've got a higher net income figure, and as a result, higher stockholders' equity. Remember, net income is transferred into stockholders' equity. We take this year's net income, subtract dividends, and that's the change in retained earnings. So net income is higher, equity is higher until the final year. Income volatility, of course, is going to be much greater under completed contract because nothing hits the income statement at all in the phases of construction until that contract is finally complete and sold, and then bang, you're going to get all of your profit going through there. So much more volatile earnings, whereas percentage of completion is spreading that profitability over the life of the contract, giving you less volatile earnings. And remember, what is volatility? Volatility is risk. So we're going to have a less volatile and as a result less risky income statement for our shareholders under percentage of completion rather than completed contract. Cash flow, exactly the same for both. The cash flows, of course, are just when the customer pays us and we incur cash expenses as we construct the asset. It's just pure accounting treatment we're talking about here. Okay, so let's turn our attention to the installment sales method. So remember, we use installment sales where we've sold goods, allowing the customer to pay on installment, but we're not certain whether they're going to pay us. So during X0, Cook Incorporated has sold $20,000 of inventory on installment with a cost of $10,000. So during X0 and X1, Cook collected $8,000 and $12,000 respectively of its accounts receivable. Under the installment method, what are the sales and gross profit to be recorded in each of the 2 years? Okay, now it's a fairly straightforward process. The sales figure will just be the cash collected in each year. Okay, so you've got 8,000 in X0 and 12,000 in X1. The cost of sales, well, we're going to include the cost of sales in proportion to the cash we've collected to date. So in X0, you've received 8/20ths of the total cash, and as a result, you're going to bring in 8/20ths of that cost of goods sold figure. So notice you get 4,000 in X0 and 6,000 in X1, computed as the proportion of cash collected to date, so 8,000 over 20,000 times the cost of the inventory you've sold, 10,000. That's 4,000 in X0. Notice in X1 we've received 12,000 out of a total of 20,000, so 12/20ths times 10,000, and we get 6,000. So our gross profit is 4,000 in X0 and 6,000 in X1. Let's have a look at the cost recovery method. It's going to be essentially exactly the same in terms of the total profit recognized. It's just that the timings are going to differ. So notice this time Cook Incorporated has sold $20,000 of services, but they did not know what the cost of producing those services were at the outset of the contract. So remember, for cost recovery to be in play, you've got two sources of uncertainty. In other words, whether the customer will pay you and the total cost of providing the good or service. With installment sales, there's only one source of uncertainty, whether the customer will pay when their installments are due. Okay, so we didn't know the costs at the outset of the contract. Notice we've received 8,000 in the first year, 12,000 in the second year, just exactly the same way as we did in our previous example. The project was completed during X1, at which time we'd incurred a total cost of 10,000. Okay, so let's have a look at the impact. When we do this, we'll bring in sales exactly the same way as we did with the installment method, i.e. according to the cash we've received in each year. So 8,000 in year one. Now, in year one, we've yet to recover our full costs. Our full costs are 10,000, and we haven't recovered those yet. So all we'll do is we'll match the cost of goods sold to the sales figure and show zero profit. So we've only recovered 8,000 out of a total cost of 10,000. In X1, of course, the sales figure here is 12,000. The remaining cash, recording it as we receive the cash, we've only got a further $2,000 worth of costs to recover, meaning our gross profit is 10,000. So notice we've got the same gross profit as we did with the installment sales method. All that's happened with cost recovery is we have delayed recognition. So we're not recognizing it until X1, whereas of course under the installment method, some was recognized in X0, some was recognized in X1. Now be aware how it works under IFRS. It's a slightly different approach for the installment sales. What you're going to do is record the present value of the installment payments, and you record it as a sale at the time of sale. Now the difference between the payments you'll actually receive in the future and the present value that you've recorded as a sale is going to be treated as interest and spread over the life, if you like, or the time it takes to collect the cash from your customer. Okay, notice that's used instead of the installment sales method. If the outcome of the project cannot be estimated reliably, i.e. you don't have an idea of what the total cost is at the time you enter the contract, then you use the cost recovery method under IFRS, just like you do under US GAAP. Okay, we're also asked to be a little bit aware of barter transactions. What is a barter transaction? Well, when we've exchanged goods or services between the two companies rather than one company paying cash for a good or service. So for an example, A has agreed to exchange inventory in return for receiving a service from B. So what are the rules? Well, notice IFRS says record a sale, and that sale should be equal to the fair value of similar non-barter transactions with related parties. In other words, record the sale at the price you've received for similar transactions in third-party arm's length transactions. Unrelated parties, of course, means no related parties, no corporate insiders, shareholders or directors, because of course the problem with corporate insider transactions is they may not be at proper commercial terms, they may not be at arm's length. Notice US GAAP is pretty similar. Notice revenue equals the fair value, but only if the company has sold these goods for cash in the past. If it hasn't, instead, the sale is recorded at the carrying value of the asset that's been exchanged. Gross versus net reporting, this is really to do with internet merchandising companies. So companies a bit like Amazon. Now, some of these merchandising companies may sell you the product but never hold it in their own inventory. You might have noticed this. Sometimes, essentially, all that Amazon does is it sells the product and then passes your order to one of its third-party retailers. In this case, then the internet-based merchandising company is really acting as an agent. All they're really doing is arranging for one of their suppliers to ship directly to the end customer. So, essentially, in that situation, they're acting like an agent, so they should report the net sale. Notice the gross reporting, we show the sale separately, the cost of goods sold separately, and as a result a gross profit. If we're acting as an agent, then we just report the gross profit as a sales figure. We just bring in the 20, as if we were like an agent and this was our commission. US GAAP gives us a little bit of guidance about when we should report gross. Now it says if the company making the sale is the primary obligator, so they have the responsibility with the customer, if they hold the inventory and as a result they bear inventory risk such as obsolescence, if they have the credit risk if the customer doesn't pay, if essentially the merchandising company can actually choose which supplier to fulfill the order, and if we have latitude to set price, then essentially we're going to report gross. So show the sales figure and show the cost of goods sold separately and as a result gross profit. If you don't meet the criteria, then essentially you're acting as an agent, so just report the net revenue. So what are our implications for analysis here? Well, essentially anything that leads to earlier revenue recognition is considered aggressive. So percentage of completion is considered more aggressive than completed contract. So anything that leads to later revenue recognition is conservative. So likewise, cost recovery would be more conservative than installment. No matter what we use, you've got to be aware that estimates are used in the methods. Just think about percentage of completion. It's reliant on an estimated total cost, a reliable estimate of total cost, in order to bring in the revenues, essentially, over the life of the contract. So there's a lot of estimates going on that affect the data and therefore affect the sales and the accounts. Now, of course, the analyst needs to know if they're comparing two companies and one's maybe used percentage of completion and one's used completed contract, they need to be aware that they're not comparing like with like, and as a result, how it reduces the comparability of the ratios that they calculate. Okay, so let's have a little look at an example here. We've got a project that's going to cost 10 million, and the contract totals 12 million. So that must be our contracted selling price. So we think there's going to be a 2 million profit on this contract. What else are we told? 2 million of costs are incurred in year 1 and year 2. So we've got 2 million in both years. Invoiced amounts are 4 million a year. Well, that sounds like a red herring to me. We didn't use invoiced amounts at all when we looked at percentage of completion before. So 4 million is invoiced in year 1, 3 million invoiced in year 2, and 1 million of cash is collected. Now, of course, all of that latter data is irrelevant. To work out percentage of completion, all we need to know is contracted selling price, costs incurred to date, and the reliable estimate of total cost. So we're asked to calculate the income in year 2. In year 2, we've incurred 4 million of costs to date. So that, of course, is a total of 4 million over the total contracted selling price, total estimated cost of 10 million. So we've incurred 40% of costs to date times the contracted selling price of 12 million, giving us 4.8 million. Now 4.8 million, of course, is the cumulative income recognized to date. We need to knock off anything that's been recognized in year 1. So let's have a little look at what's been recognized in year 1. Year 1 would have been 2 million over 10 million, so 20% of the contracted selling price, which is 2.4 million. So we've got cumulative revenue to date in year 2 of 4.8, 2.4 recognized in year 1, so the sales figure we should recognize in year 2 is 2.4 million. So sales are 2.4 million, we incurred 2 million of costs in year 2, and as a result the profit we should show is 400,000. Okay. Notice they've done a little bit of a cheaty shortcut calculation here. Because the reliable estimate of total cost was constant from year to year, we could have just done cost incurred in the year over total cost times profit, essentially 12 million the contracted selling price minus 10 million the reliable estimate of total costs. Our next LOS asks us to describe the principles behind expense recognition. Here we're going to look at particularly the accruals method of recording expenses. Now, essentially, if you incur a cost that's going to generate revenues or is related to revenues, then we apply the matching principles and match the cost against the revenues generated. Now, a really good example of this is depreciation. If you buy a long-lived asset that you're going to use in your production process over a number of years, then hopefully it's going to generate sales over a number of years. So we store its cost initially when we buy the asset in the balance sheet, in our PP&E. We then release that cost to match against the higher future revenues, and the method for doing this, of course, is depreciation if it's a long-lived tangible asset, PP&E, or amortization if we're looking at an intangible asset. We've got other examples of matching as well. Inventory is a good example of matching. Our costs of goods sold should include the same number of units as we've physically sold. So we take our beginning inventory, add on our purchases to get the number of units available for sale, and if we haven't sold all of those units, we take out the ending inventory, we subtract the ending inventory and transfer it into the balance sheet, so that the cost of goods sold includes the same number of units of cost as the number of units that we physically sold. Warranty expenses. Now, a warranty expense, of course, warranties are all about repairing faulty goods. Now, of course, at the time of the sale, you don't know what that warranty expense will be. So we're going to have to estimate it. But the matching concept says we should match cost against revenues, so we'll account for the warranty at the time of the sale, not when the faulty goods are actually returned for repair in the future. Doubtful debt expense is another good one. We know in our accounts receivable some of the cash won't be collected from our customers, and as a result it's not an asset. Remember, an asset needs to lead to a future inflow of benefit. So we deduct the doubtful debt expense from accounts receivable in the balance sheet and show it as an expense in the income statement. So we use the matching principle for any costs that are directly related to revenues. If we've got any costs that aren't directly related to revenues, then we call them period expenses and we match them according to the period of use. So for example, if you've occupied your premises for 1 year, you would want to see 1 year's worth of rent going through your income statement. Now, what we're also going to notice is because of this accruals process, we're going to have a lot of estimates and assumptions that will affect our income statement. So for example, for inventory valuation, we're going to have to value this ending inventory that we take out of our cost of goods sold and transfer into our current assets in the balance sheet. And we're going to see we have a number of different methods for valuing our ending inventory, FIFO, LIFO and average cost, that we're going to discuss in a little while. Warranty expense. You don't know what the cost of repairing faulty goods will be at the time you make a sale, so we've got to estimate it. Depreciation. Well, of course, depreciation is all about spreading the cost of an asset over its life, and therefore we've got estimates involving the asset's life, and we're going to see estimates involving salvage value that affect the depreciation expense. Again, we're going to see depreciation calculations in some detail in a later reading. Amortization really is just the depreciation of intangibles, so again it's affected by the estimated life of the asset that we use. Doubtful debt provision. Do you know what proportion of customers won't pay you? The answer is no, not when you make the sale, so it is an estimate based on past experience. Our revenue recognition methods had assumptions and estimates. They had a reliable estimate of total cost in there, and of course that was an estimate. So whenever we see estimates and assumptions being used in the accounts, we need to review year on year for consistency, and we need to review the footnotes because of course that's where we're going to pick up the estimates that are being used. And of course in the footnotes they will tell us about any change in accounting estimates. Remember, in management discussion and analysis, we're also likely to see discussion on why there was a change. So here are a few little examples. Inventories, we're not going to dwell on this massively here simply because it's repeated so many times elsewhere in the syllabus. But we know that if we take our beginning inventories, add on, and beginning inventory of course is just last year's ending inventory, add on this year's purchases, we get the total goods available for sale. If we haven't sold them all in the year, we then subtract ending inventory to get our cost of goods sold. That way our cost of goods sold includes the same number of units in it as the items that we physically sold. So in other words, we're trying to match cost of goods sold to the items that we've sold. Now of course, as we've said, there are a number of different methods we can use to value our ending inventory. FIFO, first in, first out. LIFO, last in, first out, which can be used under US GAAP but not IFRS. Average cost, and also specific identification. We're going to talk about all of these in more detail later on. Depreciation, we've talked about this as well. We said it's spreading the cost of the asset over its life. So let's have a little look at an example. You've bought a truck, it's going to cost you $20,000. You're going to use it, you think its total life is 100,000 miles. So $20,000 divided by 100,000 miles gives you 20 cents. So therefore you should depreciate it by 20 cents per mile used, reduce the value of the asset in the balance sheet, and put that depreciation in your income statement as an expense. You've got an oil tanker that will last for 25 years and then be sold for scrap. And we're going to use straight line depreciation. So we just take the cost minus its scrap value over 25, its estimated useful life, and that gives us our depreciation expense. DVDs. DVDs purchased for rental, well of course they're going to decrease in value very rapidly in the first year. Now, when a DVD is new and it's of a new film, of course, lots of people are going to want to rent it, so it's going to generate very high revenues. As the film gets older, of course, most people have seen it, and as a result, the rental revenues it's going to generate are going to fall. So as a result, we're likely to use an accelerated depreciation method. An accelerated depreciation method will charge more depreciation through the income statement when the asset is young, and less as it begins to age. Now, under IFRS, it says you must match the depreciation method to the earnings potential of the asset. So if it generates constant earnings over its life, you can use straight line. If it generates more earnings when it's young and less when it gets older, then you must use accelerated. Note, US GAAP does not say this. So essentially, even if the asset was generating higher earnings in the early years and lower earnings as it matured or got older, you could still use straight line. Amortization. Well, amortization is really just the depreciation of an intangible asset. So our intangible assets are things like patents, royalty agreements, franchise license that we've bought, etc. And we're going to spread the cost over their life just as normal. Now, if the earnings pattern, in other words, we don't know the earnings pattern of the asset, then international accounting standards say use straight line. And of course, this is very typical. Both IFRS and US GAAP firms will typically use straight line amortization, assuming zero salvage value. So essentially it's just cost divided by the asset's useful economic life. Be aware there's one intangible asset that does not get amortized, and that's goodwill. And goodwill arises when you acquire another company, and again we're going to see this in just a little while. Goodwill is the difference essentially between the price you paid to acquire another company and your share of its net assets after adjustments to fair market value. So if the price you pay is greater than your share of fair market value net assets, the difference is goodwill. It's put into your balance sheet. Now potentially it has an unlimited life, and as a result we don't depreciate it, but instead we're going to have to subject it to an annual impairment review that again we're going to talk about in later readings. Our next LOS asks us to discuss unusual or infrequent items, discontinued operations, extraordinary items, and accounting changes. So let's start off with our unusual or infrequent item. Remember, these are above the line, above the tax line. As a result, they're reported gross, and any tax on these items is included in your provision for income tax. Now, these items have to be unusual or infrequent. So unusual to our day-to-day business operations or very infrequent, but not both. And we get some guidance on what to include. So we might include the gain and loss when we dispose of a business segment or its assets. And of course, all we're going to do is look at the proceeds when we sell the asset compared to the carrying value at the time of disposal, and the difference is the gain or loss. Likewise, we might look at the gain or loss when we sell the shares in a subsidiary. We've also got provision for environmental remediation. So if we've polluted the environment and we know we're going to be fined, that fine, that provision, the estimated fine, will be treated as an unusual or infrequent item. Impairments. Now impairments are when essentially the fair value of a balance sheet asset has fallen below its carrying value. Whenever you hear the phrase carrying value, it just means the value in the balance sheet. So if fair value is dropped below the carrying value, you have an impairment and you have to reduce the balance sheet value of the asset in the balance sheet. This reduction in the asset goes through as an unusual or infrequent item as an expense in the income statement. Write-offs and write-downs tend to be more, they're a bit like impairments, but they tend to relate to inventory. Now, of course, if your inventory has become completely obsolete and you're not going to be able to sell it, you're going to have to write it off. Because you're not going to be able to sell it, it's no longer an asset. It's not going to generate any future inflows of benefit. So you have to eliminate it from the balance sheet and put it through the income statement as an expense. A write-down is where essentially the net realizable value of your inventory has fallen below its cost. Net realizable value essentially is going to be what you can sell the inventory for minus any costs of selling. So if net realizable value declines below cost, you have to write down your inventory to its recoverable amount, and that write down also goes through the income statement as an expense. Restructuring, so essentially restructuring divisions, any costs involved in restructuring will be unusual or infrequent, and also any integration expenses that you've incurred for recently acquired businesses. Excuse me. Discontinued operations. These are operations where the management has decided to dispose of the operation, but either hasn't done so in the year or did so but part way through a year. Now the key point is, if you decided to dispose of it or did it so partway through this year, it's not going to generate earnings in future periods. As a result, we want to keep its operating results, i.e. its sales, its cost of goods sold, its gross profit, its sales general and admin, its operating profit, etc., distinct from the continuing operations of our business. So all we do therefore is show the net result of this division, i.e. its profit, as a separate item, so it doesn't get included with the continuing operations of the business. Why do we want to do this? Well, we don't want the analyst to pick up on these earnings and build them into future forecasts. Notice it's reported below the line, so we report it net of tax. So the tax is netted against the line, or the item in that line. It does not go through the provision for income taxes. Notice as well, for it to be a discontinued operation, the assets, operations, financing activities must be both physically and operationally distinct from the firm. Extraordinary items. You only see these under US GAAP. They are prohibited under IFRS. These are items that are both unusual and infrequent. They're going to be reported reported after tax, so they're going to be reported net, essentially. What items have we got? Losses from expropriation of assets. So you've got an overseas subsidiary, and essentially maybe those assets have been taken by that overseas government. Well, if you've lost your assets, they're no longer going to generate future flows of benefit, so they no longer meet the criteria of an asset, so we need to remove them from the balance sheet and put them through the income statement as an expense. Also, we might see the gains and losses from early retirement of debt treated as extraordinary, but only if it is both unusual and infrequent. And then finally, uninsured losses from natural disasters such as earthquakes, tornadoes, eruptions. We then move our attention to accounting changes. And we have two types of accounting change: changes in accounting principle and changes in accounting estimates. Now, if we change our accounting principle, so maybe we move from LIFO inventory valuation to FIFO, or maybe we move from accelerated depreciation to straight line, then it's deemed to be a change in accounting principle and we have retrospective application, i.e. you need to show the previous year's comparative figures as if that policy had been applied to that year as well. Okay. Now, if it's deemed to be a change in accounting estimate, we do not need to go back and restate prior years. Instead, all we do is disclose in the footnotes that there's been changes in accounting estimates and then show the net impact going forward. Now, of course, this means big accounting estimates that we see, such as the ones in depreciation, the asset's life, and its salvage value, if you change those estimates, you do not have to restate prior period earnings. Prior period adjustments are really correcting errors from an incorrect accounting method to one that is generally accepted by the GAAP. So typically, if we do find errors, essentially, we will need to go back and restate the prior period's financial statements. Also notice we have to disclose the nature of the error and its impact on net income in that period. Right, let's turn our attention to non-operating items. We're asked to distinguish between operating and non-operating items. In particular, when we're looking at investments. So notice interest received, dividends received, gains and losses on the disposal of investments. Now, is it an operating item? Is it a non-operating item? The answer is it's going to rather depend on the nature of the firm. If the nature of the firm is that it is an investment firm, i.e. an investment bank, then holding portfolios of securities, receiving income and making gains and losses is part of the core day-to-day business activities, so we'd like to see these items within our operating profit. If receiving investment income and making gains and losses is not part of your core operations, so let's take the example of Kaplan. Kaplan is a training and education provider, not essentially an investment bank. So receiving dividends, interest, and making gains and losses on investments are not part of the core activities. So we need to see it reported as non-operating income. So for a financial service company, it is an operating activity. For a non-financial service company, then we're going to treat it as non-operating income. Keep it away from the results from your core business operations. Our next learning outcomes relate to earnings per share. And we've got really two learning outcomes that we're going to combine. One asking us to describe and calculate earnings per share, and one asking us to differentiate between dilutive and anti-dilutive securities. So let's start off by talking about simple and complex capital structures. A simple capital structure is simply one that contains no potentially dilutive securities. Well, that leads us to ask straight away, what is a potentially dilutive security? It's any thing that the company has in issue that could be converted into new shares in the company at a later date. So it could be convertible bonds, it could be convertible preferred stock, it could be employee stock options, it could be warrants. Now, essentially, if you don't have any of these dilutive securities, potentially dilutive securities, then you only need to report basic EPS, earnings per share. If you have a complex capital structure, then you do have potentially dilutive securities, in which case, if they're deemed to be dilutive, and we'll talk about the difference between dilutive and anti-dilutive a little later, but if they're deemed to be dilutive, you're going to have to report both basic and diluted earnings per share. So let's have a look at some of our potentially dilutive security. Stock options. Now be careful. These are employee stock options, not traded stock options. Okay, so they're not exchange traded options, because exchange traded options tend to be on existing shares. We're only interested in instruments that would create force the company to issue new shares. So they're employee stock options. Warrants. Warrant, of course, is very much like a call option. Gives the holder of the warrant the right to buy shares in the company at a predetermined price. Why is it not a call option? Well, as we said, a call option is on existing shares, a warrant is on brand new shares. So if you exercise your right to buy with a warrant, the company will have to issue new shares. Convertible debt, of course, can be converted into common stock, and convertible preferred stock as well could be converted. Now let's talk about this distinction between dilutive and anti-dilutive. A security is deemed to be dilutive if, when we look at whether it would be exercised or not, if it causes EPS to fall. Now we're going to look at these instruments and pretend that they are essentially converted at the beginning of this year, regardless of whether they actually can be or not. So if on conversion this year they were to cause EPS to fall, they're dilutive. If on conversion this year they were to cause EPS to rise, then they're anti-dilutive, and we ignore them from our EPS calculation. So we only want to include the potentially dilutive securities that cause EPS to fall. Okay, and remember, whether these instruments can be exercised in this year or not is irrelevant. We make an assumption that they're all converted at the start of the period. What we're trying to do is show our shareholders, here is your current EPS, here's how it would fall if these instruments were exercised in the future. So let's have a look at our basic earnings per share calculation. Our basic EPS is net income minus our preferred dividends. What we're looking at there is the profit attributable to common stockholders. Why do we deduct the preferred dividends? Well, because legally, preferred dividends, i.e. preference share dividends, must be paid before you can distribute a dividend to your common stockholders. So if we take net income and subtract the preferred dividend, and in fact any arrears on preferred dividends, then we get the profits that could be distributed to our common stockholders. And we're going to divide that through by the weighted average number of shares in issuance during the period. And notice we're only using common stock here. Weighted average only kicks in when you've got share issues and buybacks during the period and bonus issues. If you didn't, then it will just be the number of shares held at the beginning of year and end of year. Okay, let's talk about the treatment of stock dividends and stock splits. A 10% stock dividend will simply increase the number of shares outstanding by 10%. But remember, stock dividends and stock splits are essentially cosmetic transactions. They increase the number of shares, but no cash is received by the company. As a result, automatically they would cause EPS to fall. Now notice as well, a 2-for-1 stock split. What does this mean? You now have 2 shares, you did have 1 shares. So be very careful if you're European, because we would read 2-for-1 as 2 new shares for every 1 existing share. That's not how this is read in the US. They say you now have 2, you did have 1. Okay, so in other words, this is what a European would call a 1-for-1 stock split. Okay, so essentially a 2-for-1 stock split using US terminology will increase the number of shares by 100%. Again, no cash is raised. Now, of course, these are purely cosmetic transactions. However, because the number of shares increases, it's going to cause EPS to fall. So what we're actually going to do is we're going to pretend that the stock dividend or stock split occurred at the beginning of this year. So we're going to apply it retroactively to the beginning of this year. And we're also going to go back to the prior year and adjust that as if the dividend or split had occurred in that year as well. What we don't want to suddenly see is our earnings per share dropping purely as a result of these cosmetic transactions. Okay, now when we're going to work out our weighted average number of shares, notice in our exam we're likely to use months. In reality, we should be using days, okay? But that would make it a bit clunky. We'd have to take into account 30 days in some months, 31 days in other months, and of course things like leap years. So our examiner tries to keep it straight and easy for us by using months. So we need to be able to calculate our weighted average number of shares in issuance for a year. So let's have a look at the following example. Okay, in our following example, we've got the number of shares outstanding at the beginning of the year, 10,000, and that's on the 1st of January. Then we've got on the 1st of April 4,000 shares being issued. Remember again, if you're European, then typically we read this as, we would read dates as day, month, year, but remember it's an American exam, so you're seeing month, day, year. So 4 represents the month, and then as a result we're looking at April. So on the 1st of April they issued 4,000 new shares. On the 1st of July there was a 10% stock dividend, and then finally on the 1st of September they repurchased 3,000 shares. The first thing to do is take that stock dividend on the 1st of July and retrospectively apply it to all of the shares in issuance prior to the date of that stock dividend. So it's going to affect the 10,000 shares at the beginning of the year, and it's also going to affect the shares issued on the 1st of April. What it won't do is affect the repurchase on the 1st of September, because that repurchase took place after the date of the stock dividend. So let's increase the shares at the beginning of the year by 10%, and let's increase the shares issued on the 1st of April by 10%. Notice the shares repurchased, because this is after the date of the stock dividend, there is no impact whatsoever. Okay, so we've dealt with the stock dividend now. What we now need to do is our weighting. So our initial shares, those are in issue for 12 months of the year, so we're just going to take our 11,000 and multiply by 12, and that gives us 132,000. The 4,400 shares, they were in issue for 9 months of the year, so let's multiply by 9 to get 39,600. Finally, the shares repurchased, they were repurchased at the beginning of September, so September, October, November, December, 4 months of the year remaining, so multiply by 4 and we get 12,000. Again, notice we're assuming a 31st of December year end in our examples here. And I would say take that into the exam, assume, unless the examiner tells you otherwise, that you're looking at companies with 31st of December year ends. Okay, so let's now add up our weighted shares. 132 plus 39,600 minus 12,000 gives us 159,600. All we now need to do is take that figure and divide by 12 to get the weighted average shares outstanding to use in our denominator. So 13,300, and that's what will go in the denominator of your EPS calculation. Okay, let's turn our attention now to computing diluted earnings per share. We've got an overview slide, but then we're going to break each one of these down in turn. So notice we've got net income minus preferred dividends. Now, of course, if you've got convertible preferred stock, if that's converted into common stock, you would save the convertible preferred dividend. So we need to add that back on our numerator, but we need to include the increase in the common stock if it was converted. So the shares from the conversion of the convertible preferred stock would be included on the denominator. Remember, we only include these if they're dilutive, i.e. they would cause EPS to fall. Likewise with convertible bonds. Now if you convert the bond into common stock, of course you're no longer going to be paying the coupon. So you're going to save yourself the interest, but if you save yourself the interest, you're going to pay more tax, because remember, coupons are tax deductible. So actually we only want to add back the net interest on our numerator. So that's why we've taken convertible debt interest times 1 minus t. On our denominator, we'd include the number of shares that are created on conversion. Again, remember, we only include these if the security is dilutive, and as a result would cause EPS to fall. Employee stock options and warrants have no impact on our numerator and only an impact on our denominator. And again, we would only include these if they're dilutive, and we're going to talk about how to spot this one at a time. So let's move in and talk about this idea of checking for dilution. We've already mentioned that a security is dilutive if it would cause earnings per share to fall in the current period. In order to identify that, we're going to compare it to basic EPS. Okay, now, essentially, for a convertible preferred stock, remember the impact on the numerator is the dividend saved, and the impact on the denominator is the number of new shares created. If that is lower than basic EPS, it's dilutive. If it's higher than basic EPS, then it's anti-dilutive. And remember, if a security is anti-dilutive, then we ignore it. We only include dilutive securities in our diluted EPS calculation. Convertible debt, well, of course, we'd save the net after-tax interest on our numerator, but we get the increase in number of shares on our denominator. So again, if net interest divided by number of shares is less than basic EPS, it's dilutive. If it's greater than basic EPS, it's anti-dilutive and we'd ignore. Employee stock options and warrants, we use a different technique. What we look at is the average stock price during the year and compare that to the strike price, i.e. the exercise price on the option. If the average price is greater than the exercise price, we conclude that these options would be exercised or these warrants would be exercised. And remember, it doesn't matter whether they can be in this year or not. That's irrelevant to the computation. But if they would be exercised, if they could be, then they will be dilutive. Okay, let's take each one of these in turn. Okay, so we've got earnings available to our common stockholders of 4 million. We've got 2 million common shares outstanding, and as a result our basic EPS is 2 million. We're told that there's a $5 million of 7% convertible preferred stock. I'll assume that that $5 million is its par value, and it's outstanding all the year. The terms of conversion are for every $10 nominal value of preferred stock, that can be converted into 1.1 common shares. So we need to calculate our diluted earnings per share. So what I've done is I've just started with the earnings available to common stockholders, the 4 million. Now, of course, if the preferred stock is converted, I will save the coupon. And my coupon, of course, is going to be 350,000. How did I get that? 5 million par value, 7% coupon, so therefore 350,000. So my adjusted numerator would now be 4,350,000. I also need to work out the impact on the denominator. So my par value 5 million, and remember for every $10 of par value I get 1.1 shares. So 5 million divided by 10 times 1.1, a further 550,000 shares would be created, giving me a denominator of 2.55 million. Now, what we need to do, of course, is check for dilution. And to do this, we compare to basic EPS. So remember, the impact on the numerator was 350, the impact on the denominator was 550 new shares. That, of course, is clearly lower than the basic EPS of $2, and therefore it is a dilutive security. So we can then calculate our diluted EPS as 4.35 million divided by 2.55 million, i.e. $1.71. Now, in class, normally at this point, someone will say, why did I bother checking for dilution? I can see that $1.71 is clearly lower than $2. It must have been dilutive. Yes, but we've only got one dilutive security in this example. Imagine a question in the exam when you've got a number of potentially dilutive securities. If you jump to the end calculation, it may be lower than basic EPS, but you could accidentally include an anti-dilutive security. So you do need to go through the process of checking each dilutive security against basic EPS if you have more than one dilutive security or potentially a dilutive security in the exam. Let's turn our attention to convertible bonds. The process is pretty much exactly the same as our convertible preferred stock. All we need to remember, of course, is there's a tax effect, because if you no longer pay the coupon, you're going to pay more tax. Okay, so we've got some earnings available to our common stockholders of $2.5 million, 1 million common shares outstanding, and as a result, basic EPS is $2.5 or $2.50. The tax rate in this case is going to be 30%. This company's got 2 million par value of 5% convertible bonds. They've been outstanding all year. Each $1,000 convertible bond can be converted into 120 shares. Okay, let's have a look at it then. So again, I'm starting with my earnings available to common stockholders, but I'm then going to say, well, look, if this bond is converted, I'm going to save the coupon. And of course, I've lost my example. Where are my data? 5% of $2 million. We would save a coupon of 100,000. But if we save that coupon of 100,000, our profit before tax would be 100,000 higher, and as a result, we'd pay 30,000 more tax. So actually, the net impact on our numerator is 70,000. So our numerator is now going to be 2.57 million. On our denominator, we originally had a weighted average number of shares of 1 million. If our bond is converted, well, let's take the $2 million, divide the par value by 1,000, the par value of each bond, and each bond is converted into 120 shares, giving 240,000 new shares. Okay, so let's have a look at how all this works out. Remember, first we've got to check for dilution. So you look at the net interest saving on your numerator over the number of shares created, and if that's lower than basic EPS, it's dilutive, so you include it in your calculation. Well, clearly here it is dilutive. So then our diluted EPS is the adjusted numerator over the adjusted denominator, and we get $2.07. Okay, so we've done convertible preferred stock, we've done convertible bonds. What we now need to do is turn our attention to employee stock options and warrants, and the technique is going to be rather different. For employee stock options and warrants, we're going to use something called the treasury stock method. Now, first of all, remember, these are only going to be dilutive if essentially they would be exercised during the year. And the accounting, both IFRS and US GAAP, says in order to establish this, compare the exercise price on the option to the average price during the year. It's not the opening price, it's not the year-end price, it is the average price. Okay, so essentially if the strike price is lower than the average price, then these options would be exercised, or the warrants would be exercised, so it's going to be dilutive. If the average price is below the strike price, they wouldn't be exercised, so they'll be anti-dilutive. Now, if they are dilutive, we're going to use the treasury stock method. What we do is we run through these steps. First of all, we look at the number of shares that will be created if the options are exercised. Step 2, we work out the cash received by the company if the options were exercised. And step 3, and this is totally hypothetical, what we'll then do is look at the number of shares the company could repurchase at the average share price during the year with the proceeds it received from step 2. Now, we then calculate the dilutive element by looking at the number of shares that were created minus the number of shares that could be theoretically repurchased at the average price, and that gives you the dilutive element. Well, let's jump straight into an example to see this in play. So we've got earnings for our common stockholders of 1.2 million. There's 500,000 weighted average shares in issue. So we've also been told, what have we been told? Average price of our common stock during the year was $20. Strike price on these options, $15. Well, straight away we can tell these are dilutive because the average price during the year is greater than the strike price. Just ask yourself, do you fancy buying something that's worth $20 and only paying $15? If the answer is yes, it's dilutive. So these are dilutive. Notice we've got 100,000 stock options. Basic rule for the exam is assume one option equals one share when exercised unless told otherwise. And we've got our basic EPS here of $2.40. Excuse me. So let's calculate it by going through our steps. Step 1, we look at essentially the number of shares that would be created if the options are exercised. So we're going to assume one option equals one share, so 100,000. Step 2 moves on and says, well, okay, what cash would be generated on the exercise? Remember, we're going to take the number of shares here times the strike price of $15. So 100,000 times 15, we would raise $1.5 million. The next step, and it's completely hypothetical, we're going to take that $1.5 million and use it to buy back shares at the average price of $20 in the year and look at how many shares we could buy back. So 1.5 million divided by 20 gives us 75,000 shares. We could buy back 25,000 shares at full price using our proceeds. So finally, the dilutive element is 100,000 shares issued, 75,000 essentially could be bought back at full price, and as a result, the dilutive element is 25,000. Look, what is this calculation really doing? I think this is a long-winded way of doing something that's quite straightforward. What we're saying really is we're allowing our warrant holders or employees to essentially buy shares at $15 when the fair value of those shares is $20, i.e. we're giving them a 25% discount. So 25% of the shares that are issued must be dilutive. So we could take 100,000 and multiply by 0.25, the size of the discount, and we'd get the dilutive element of 25,000 straight away. Of course, our diluted EPS, no impact on the numerator. The profits attributable to common stockholders, they're not affected, so that's 1.2 million. On the denominator, we're going to take our weighted average number of shares, 500,000, plus the diluted element of 25,000, and we've got a diluted EPS here of 229. Okay, finally we're out of EPS calculations, so expect to see those in the exam, and we're now into our next learning outcome that asks us to convert income statements to common size income statements. Now, an income statement, of course, is all shown in dollar values or euro values or whatever currency you're looking at. And the problem is, because it's in monetary terms, it's in absolute terms. You can't really compare firms of different sizes. What a vertical common size income statement attempts to do is move from these absolute figures to relative figures so we can compare firms of differing sizes. Now, simply the way we do this is we take the income statement line and divide it by sales. So every item in the income statement is shown as a percentage of sales. So, for example, if you had marketing expense, it would be marketing expense divided by sales. You'd look at cost of goods sold divided by sales, interest divided by sales. So everything is shown as a percentage relative to the sales. Then, of course, we can look at our management discussion and analysis and see if these percentages make sense. Of course, we can look at time series. We could look at how these percentages are changing over time for the company. And we can look at cross-sectional and compare firms of differing size. Now notice, two of our profit margins will be on the face of a common size statement. And that's the gross profit margin and the net profit margin. Gross profit, remember, is sales minus cost of goods sold. And the gross profit margin is gross profit divided by sales. So you will see the gross profit margin on the face of a common size income statement. Likewise with net profit margin, which is net income divided by sales. Again, you'll see that on the face of the common size statement. Last LOS for this reading is to describe and calculate comprehensive income. So we've talked about this before and said, look, we need to show this statement of comprehensive income. What is it doing? Well, essentially, what it's trying to do is pick up on all of the change to stockholders' equity that is not directly related to transactions with the shareholders. So in other words, the change in stockholders' equity that doesn't relate to new issues of shares, buybacks of shares, or dividends. So we're trying to pick up, therefore, on all of the gains and losses for our investors, whether they've gone through the income statement or whether they've gone directly into stockholders' equity. So notice our starting point here is to take net income from the income statement. What we then need to do is look for items, unrealized gains and losses that have been taken directly through to stockholders' equity and haven't gone via the income statement. Now again, a lot of these you need to be able to identify them without really knowing why they've been caused. So what we'll look at is the change in any foreign currency translation adjustment that's sitting in stockholders' equity. Now, foreign currency translation adjustments result in converting an overseas subsidiary back to your reporting currency using something called the all-current method, which is in the level 2 syllabus. Minimum pension liability adjustments, or the adjustment from balance sheet asset or liability to funded status. Again, essentially, those are going to go through our comprehensive income, or the change in them is. So notice it's the change in these items, change from last year's balance sheet to this year's balance sheet, that we include. Unrealized gains and losses on any derivatives held for hedging purposes. Again, the change on those items. And unrealized gains and losses on securities held for available for sale. Now, available for sale securities are the one item which we do need to understand a little bit more detail, and we're going to see it in our later reading on the balance sheet. So notice, therefore, it is the change in these items from year to year rather than the item that's sitting in your stockholders' equity. It's the change between two balance sheets. Get those changes, add on your net income, and you've got comprehensive income, the total of gains to your equity holders, whether they're realized or unrealized. So it's net income plus changes in the comprehensive items, i.e. net income plus other comprehensive income. Let's finish the reading off with a quick little computation. Oh, it's a weighted average number of shares calculation. So we've got 10,000 shares in issue at the beginning of the year, a further 3,000 shares issued on the 1st of March, then a 20% stock dividend, and then 3,000 shares repurchased. What is going to be the weighted average number of shares? Well, remember, take that stock dividend and apply it to the 10,000 and 3,000 because they were both in issuance before the date of the stock dividend. So that's going to give us, what's that going to give us? 12,000 and 3,600. The 3,000 shares repurchased occurred after the date of the stock dividend, so is unaffected. Then, of course, we've got to time weight them. The shares in issue at the beginning of the year on the 1st of January are going to be multiplied by 12. The shares on 1st of March, they're in issue for 10 months of the year, so multiplied by 10. And then finally, the shares repurchased on the 1st of November, that's November, December, so they're only repurchased for 2 months, so multiply by 2, sum it up, and then divide by 12, and we'll get our answer of 14,500. So notice essentially what they've done here is they've taken the 10,000 shares at the beginning of the year, multiplied by 1.2 for the stock dividend. They've taken the 3,000 shares and they've said they're in issue for 10 out of 12 months. So they've multiplied by 10/12 times 1.2 because of the bonus issue or the stock dividend. Then the $3,000 repurchase, no multiplying by 1.2 because it took place after the stock dividend. They've just multiplied by 2/12 because they were in issue for 2/12 of the year, and that gives you 14,500.